Hi, evening. Happy Tuesday, everybody, and welcome to this live. And I will just kick off by asking you a very simple and real question here, right? If the market was to drop by 30% tomorrow, would you panic? Would you freeze? Or do you feel prepared? Because most people don't lose money because they are lazy or unintelligent. I want you to understand that. They lose because they were never taught how to structure investments for bad times. Many of us watch our parents work hard, save, still struggle every time the economy turns. Tonight, a simple, resilient framework is what I'm going to be teaching you so you can protect what you've already earned and compound it through any market cycle. So, this is really not about timing the market, this is actually about building a resilient portfolio, a portfolio that can survive any market circumstance. And when I say any market circumstance, I mean when the market is good, I mean when the market is rough, I mean when the market is bad, whichever thing is happening, this portfolio can be able to handle that. And of course, as usual, as you know, this is not financial advice by any chance. I am just sharing my opinions, sharing my ideas, sharing my knowledge. If it makes sense to you, use them. But these are frameworks that are proven, these are frameworks that have been able to stand the test of time, and these are frameworks that many people who are successful investors have been able to use and successfully build portfolios that are resilient. Because you must always remember it's not only about the good times, it's also about the times when the market turns around, when things don't look as good as they're supposed to look, right? When it doesn't seem like all is well. So while we think about the great times when there's a bull market, when everyone is making money, when the market is on fire, we also have to think about the times when everything is not working like it's supposed to work, when the market is down like it was down the last 1 month. By the way, this video today, this live stream is sponsored by my friends at the My Miyaka clothing line. It's a cultural brand who stand for identity and culture. And you can see the t-shirt I'm wearing is called For This Outside World, the Inside. So this has been provided by the My Miyaka brand. Check their website, mymiyaka.com, and you can give custom orders for birthday t-shirts, party wear, family reunions, any kind of customized t-shirt, cups, pens, plates, any kind of customization you want. Mymiyaka.com will be able to help you get that. So for those of you just hopping in, I usually love interaction. So wherever you are hopping in from, if you don't mind, please just drop the city where you are watching from. I like to know exactly where people are watching from. That way, it's going to help me too in the future to be able to select a time that works for most people, right? And if you are just joining too, feel free to share this with your friends, right? Invite some other people to join, of course. Share with your friends so they can join the live. And if you have any questions, you have any comments, put it down in the comment section. I'll be watching because I have the live stream going on Facebook and YouTube and Instagram right now. So I'm watching all those platforms. In case questions coming, I'll be able to respond to that. But let's get going, right? Because tonight we have something very interesting to talk about. And you must realize something. You must realize that most investors actually fail because they chase returns instead of building structure, because they want quick wins instead of building a sustainable process and discipline framework that lasts and is resilient for a long period of times. As you know, of course, if you've invested or even if you haven't started investing yet, markets are very unpredictable. I talk all the time about the fact that nobody knows what's going to happen, and that's true. And one of the things that happens with the majority of people who invest on the stock market is that they run on emotions and they run on no specific plan. They don't have a disciplined, structured plan. Because at every point in time, if you don't have a plan, you always default to how you feel. And how you feel changes from day to day, and you can never count on that, right? Number two, structure creates a process and discipline. When you have structure, what that does is that you work on what the structure is and not what on how you feel and not on how the market is reacting for that day, right? The third thing, which is very important, allocation beats prediction. Allocation in this case is what we call diversification. The most successful investors know something. They know that there is no single asset. There is no single asset class that rises forever. There is no single company that you can bet most of your money on that it will be there forever. No, things change. Some of the companies that were here 20 years ago are no longer here. So some people bet most of their money on those individual companies. I'm sure they are bleeding, right? So the whole idea of building a resilient portfolio is that balance between what is profitable, what rises, what can handle bad times. Because you must always keep this in mind, guys. In the game of investing, you must always, at every point in time, hope for the best, but plan for the worst. I want you to write that down if you have your notebook with you. You want to hope for the best, but always plan for the worst. Because even when the best is happening, you always have to plan for the time when the worst will come, for the time when there will be downturns, right? So today, I really want to just talk about how to build a resilient portfolio that can go through all the different market cycles. This kind of resilient portfolio actually spreads your risk by purpose, not by hype, which means you intentionally position yourself and construct the portfolio in a way that your risk is spread. The second thing I want you to pay attention to is that this resilient portfolio we're going to be talking about today will have multiple different buckets. And these different buckets will comprise of certain companies, certain investments, certain ETFs that are designed to participate in that risk mitigation. And some of the buckets will be designed to participate in extreme growth. Some of the buckets will be designed to participate in high risk investments. And some of the buckets will be designed to participate in the minimum amount of risk so that there is a balance across the board, right? And in this bucket, we're going to be talking about the strong structure, which starts with defense. When you are building a portfolio, especially a portfolio that you plan to hold for a long time and a portfolio that you want to make sure that it's resilient, you want to start with the defense. That's where you start building. If you watch football, I mean American football, of course, right? If you watch football, even soccer, the teams that win the most are the teams that usually have the best defense because everybody can score, right? When the team is on fire, everybody looks good. It's the same thing with the bull market. When there is a bull market, everybody looks intelligent. Everybody looks like they know what they are doing. Whatever companies you buy, just because there is a wave of positive energy on the market, every company is rising. It doesn't matter how bad that company is, whether the fundamentals is strong or not, all the companies are looking green. So it doesn't really take a special kind of skill. It doesn't take a special kind of understanding of the market. Most of the ships are going to rise just because the tide is high. Where the skill comes into play is when things don't work. When there is a downturn in the market, that's when the good companies are separated from the shaky companies. And so when you are building a resilient portfolio, a portfolio that you plan to hold for a long time, and a portfolio that you want to minimize your losses and increase your profits and increase your growth, you have to start with defense. And when I'm talking here about defense, I'm talking about defensive stocks, right? These are companies that are actually considered defensive in the industry, not because they produce defensive materials or they don't produce anything in the defense industry, but these are companies that generally don't rise too fast and don't fall too fast. So they give you a certain kind of stability, right? As I'm even thinking, as I'm going through this, one of the things that hit me too is this Bible verse, right? And by any means, I'm not a pastor or anything. I'm just a Christian too who struggles every day, begs God for forgiveness, goes to sleep at night and asks God to forgive my sins and give me energy, give me strength and courage. But I'm guided a lot by that book because it's not only a Christian book, but it's also a book that gives a lot of inspiration, right? And I was thinking about this verse. It's Proverbs 21:5. And it says, the plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. The plan of the diligent leads to abundance. Anyone who is hasty comes to poverty. That is the whole idea of resilience here. Resilience is not by accident. It's not by hype. It's by careful structural planning. And so when we're starting with the defensive stocks, right? We are starting now with companies that we know are proven to not certainly grow too fast, but usually even during times of difficulties, when there's major downturn, about the goal of this defensive portfolio is number one, to stabilize your portfolio during any kind of market situation. So we're talking here about companies like McDonald's. We all probably know McDonald's, right? Is the number one landowner in the world after the Catholic Church. McDonald's has the highest number of fast food outlets in the world. What a lot of people don't realize is McDonald's is not only in the burger business, it's actually in the real estate business. McDonald's real estate portfolio is worth more than the restaurants itself. I don't know if people realize that, right? So companies like McDonald's, you have companies like Procter and Gamble, you have a company like Walmart. These are all defensive companies because they generally don't grow too fast and they generally don't fall too fast in times of difficulty. Because no matter the economic circumstance, you will still go buy McDonald's. No matter the economic circumstance, you will still go to Walmart. No matter the economic circumstance, you still buy products from Procter and Gamble. You still buy Dove to lotion. You buy Dove body soap to wash your skin. You buy Vaseline. You buy Colgate toothpaste. You buy Sensodyne toothpaste, toothbrushes. All these things are produced. A lot of them, these consumable goods. You buy diapers for your baby. These are produced by Procter and Gamble, right? So now you are also thinking, okay, these are the individual companies which fall within the category of defensive stocks. Now let's talk about some ETFs, which is the same like index funds. These are buckets of companies, right? We have something like XLP. XLP is a consumer staples ETF, and it's actually owned and managed by State Street, right? These are essential consumer goods. These are everyday goods you and me consume on a daily basis without miss. You have something like VDC. VDC is the Vanguard version of XLP, and it's a Vanguard consumer staple. So basically, it deals in the same thing. It's similar, right? It's a broad, low-cost staple exposure. You have IYK, which is iShares US Consumer Staples, and that one is owned and run by BlackRock, which is also a leader in the ETF space for consumables. So you need to understand the first layer of this resilient portfolio is building your defensive large cap companies. And generally, and then again, this is not financial advice, all right? I'm not referring or recommending any of these companies or any of these stocks. You can buy them if you do your own research, find out if it makes sense, and you can invest in them. But just for transparency's sake, I have XLP, which is the ETF for consumable for the consumer goods ETF. I own that ETF in my portfolio. So basically, within the ranks of my portfolio, I have about 25% of my stocks and ETFs containing defensive companies like the ones I'm listed, but some other ones that basically help to make sure my portfolio is balanced. It's not only counting on massive growth, right? By the way, if this framework so far makes sense, but you are wondering how it would fill your income, family, and goals, that's exactly why I will be doing the Wealth Clarity and Legacy Blueprint webinar on February the 26th. No pressure at all. I will drop the link down in the comment or the description of this video at some point. Go check it out. That might really be helpful for you. All right. So let's move to the next one. The second bucket is the dividend income and REITs bucket. Now, I want you to understand the goal of this bucket and why this bucket too is very important. This bucket is important because it is actually the bucket that contains investments that are geared towards income. Whenever you hear about dividend is a payment that companies make to shareholders as a thank you gift for owning their shares. So generally, people who invest in dividend companies or in dividend producing ETFs, their primary goal is not fast growth. Their primary goal is to generate income. And so generally, the companies that are participating or are considered dividend producing companies, these are companies that actually pay their shareholders every quarter, which is every 3 months, a certain amount of money thanking them to hold their shares. You have to understand companies can do three things with their profits. Companies can either hold the profits within the company, right? The second thing they can do, they can reinvest those profits. So a company like McDonald's can open more stores, can employ more workers, can do more ads on TV, can increase their menu, things like that. The third thing they can do with those profits is they can redistribute a portion of those profits back to the shareholders as a thank you give. That is what we call dividends. So within this dividend space, this is the second bucket which helps with building the resilient portfolio. So we already got our foundation, which is the defensive. Now we are with the income producing stocks. We are talking about companies like Johnson and Johnson. Johnson and Johnson is a consumer healthcare company, right? If you remember baby powder when we were growing up, it was a Johnson and Johnson powder. It still exists till today. Johnson and Johnson lotion. It has a lot of different products under different brands, right? It's similar to Procter and Gamble. You have a company like Coca-Cola. Coca-Cola has been existent for as long as I don't know how long, right? You have companies like PepsiCo. So these are dividend companies because at the end of the every 3 months they pay their stock shareholders dividends. Sometimes it could range from 2.5%, 3.5%, all the way sometimes to 5, 6%, right? It just depends on the different company. Now, in this same dividend and income category, we also have something called REITs. And REITs is REITs. REIT stands for Real Estate Investment Trust. So a real estate investment trust basically are companies that invest in major real estate interests like malls, like hotel buildings, like airports, like major commercial buildings, right? And what they do is instead of you as an individual investor struggling to go and invest in a commercial building by yourself, you don't have the capital, you don't have the know-how to manage it, you don't have the connections. What these companies do is that you can buy into these companies which invest in these commercial buildings. That is called the Real Estate Investment Trust. So they basically hold all these different real estate assets in trust for their investors. So you have real estate investment trust companies like Realty Income, Public Storage. I'm sure you see Public Storage a lot in your state or wherever you live in America. Public Storage is one of the largest storage companies in America. It has a real estate trust element to it, right? There is digital realty. And one of the things that makes real estate trust very powerful is the fact that the government requires that at every point in time, by the end of the year, they must distribute 90% of their earning, their profits, back to the shareholders. So what that does is that it forces real estate investment trusts to distribute dividends, whether they like it or not. So the more profits the company makes, the bigger your dividends are going to be. So that's another income generating investment that is leveraged at the category of the dividend bucket as part of your resilient portfolio. The important thing to note, just like with the defensive one, the important thing to note with dividend and income real estate investment trust investments is that it's not growth oriented, so it doesn't grow fast. You're not going to see fast appreciation in the prices of the stock price, in the prices of the shares. You're not going to see fast growth in the value of your investment. But what you will see every quarter, you are going to get dividends. Remember the other day I did a video where I was explaining to my friend how I get my Costco membership free. And my friend told me I was kidding. There's no way I can get Costco membership free. I just explained to my friend that because I own Costco shares and Costco pays dividends every quarter, when I put together the amount of dividends my Costco shares pays me every year, it's more than the amount of money I spend on my membership. So I get my membership free and probably free groceries there too, depending on the amount of money I make as dividends, right? So dividend is very powerful. Now let's talk about dividend ETFs, because remember we're just talking about dividend stocks, which are individual stocks. And of course, you could always invest in those if that's your direction and your strategy, but don't invest without understanding. Don't invest just because somebody said so. Do your own brief research, understand it. Now we also have the ETF category, which is the category of the bucket of stocks to minimize your risk even further. And we have something like SCXY HD, which is the Schwab US Dividend Equity ETF. This is one of the most popular dividend ETFs, and for transparency's sake, I have that in my portfolio. It usually pays about 3 to 3.5%, sometimes 4%, right? In dividends every year. It is the most popular ETF dividend. So most people like to invest in income generating investments that generate dividends instead of trying to choose individual share stocks, researching them and trying to pick stocks. They basically just go ahead and invest in something like HCHD, which also has about 100 and something companies within HCHD. So within this ETF, you have McDonald's, you have Walmart, Costco, all the different companies I've mentioned and more. Right. So instead of going to pick individual companies, which is difficult because you have to research, you have to do some financial investigations, you have to understand their business model, all those things, and the risk is high, you might as well just invest in an ETF like SCHD. In that category, you also have VNQ. VNQ is actually a real estate ETF. So within VNQ, you have companies like Realty Income, you have companies like Public Storage, Digital Realty, and many other real estate companies. You also have an ETF like IYR, which is the iShares US Real Estate ETF, and that is owned by BlackRock. VNQ is owned by Vanguard, and HCHD is owned by Schwab. You probably know all of these investment companies, right? So if you're just joining me again, you're welcome. Please feel free, drop a comment down. Let me know you're watching. Let me also know where you're watching from. I usually just love to make sure I can capture where everybody is watching from, so that way I can know exactly who is on. I can actually give you a shout out wherever you are, right? So let me know that. So let's come down now to the next category. So that's the second bucket, which is the income bucket. Now let's talk about the cyclical and industrial leaders. Now, at this level of the cyclical and industrial leaders, you are thinking here about companies that are cyclical. These are companies that basically are very solid companies, but their growth is cyclical. Depending on economic circumstances, depending on what is happening in the economy, their growth can change from time to time. So we're talking about companies here that can be sensitive, for example, to interest rate drop or interest rate changes. They can be sensitive to the focus of the administration in place. So let me give you an example. You have a company which is a cyclical company like Caterpillar. Caterpillar is a company that sells heavy machinery, like you know. And so Caterpillar naturally, if the government in place decides that they want to do a lot of infrastructure bills are passing in the Senate and they want to invest a lot in infrastructure, naturally the value of Caterpillar will rise because there will be an increased demand in Caterpillars to construct. They are projecting that the value of Caterpillar is going to rise over the next few years because they need all this heavy equipment to construct data centers to support AI operations. So you have to think about how these things are interconnected when you're dealing with individual stocks, right? That is why generally individual stocks are more challenging. It needs a lot of expertise. It needs a lot of understanding. It needs a lot of knowledge. You don't just start investing in individual stocks like a joke. No, you have to spend some time to research the finances, the budget, the financial state of the company and all those things, right? But the cyclical bucket, which is the third bucket, are companies that rise and fall depending on certain influences. And cyclical is important too because it provides a certain amount of gains when when the cycle is positive for them, and even when the cycle is not positive, they don't fall as fast. So you have companies like Caterpillar, you have a company like Honeywell. Honeywell is a manufacturing and industrial manufacturing company. Honeywell is as old as you can imagine. It's a company that makes ACs. If you look in your house, most likely your AC unit is a Honeywell unit. These are companies that nobody really talks about, right? They are the backbone of the economy. Nobody talks about because they are not flashy. It's not one of the Googles or the Nvidias of this world, but they've been existent for 100 plus years and they've been consistently being in business, right? These are companies that have global reach. So basically, they don't grow as fast because they are mature and they are massive, but they don't drop as fast either. So they provide a certain kind of balance. You have a company like 3M. 3M is a company that is involved in science research. It involved in producing, paper materials, stationary materials, healthcare materials, drips, different things that they use in the healthcare industry, in labs, in operation rooms, and things like that. Now, for the ETFs of this category, you have XLI, which is the Industrial Select Sector Spider Fund, which is owned by State Street. You have VIS, which is Vanguard Industrials ETF, and you have IYJ, which is the iShares US Industrials, right, owned by BlackRock. All of these are just examples of ETFs I'm giving you. But of course, you can always do the individual stocks or you can get the ETFs. It doesn't matter, right? The ETFs, most people I recommend the ETF just because it's a lot safer. It doesn't have too much volatility and you don't have to spend time trying to research too much on the individual companies. All the individual companies that I mentioned and even the ones I didn't mention under the cyclical bucket, most of them are in this ETF. So you can take the shortcut if you want to get the ETF. But if you don't understand a lot of these things, which I recommend you have a little bit of understanding, you should join the webinar coming up on the 26th because I'll be breaking down these concepts and many more, giving you a clear roadmap to start investing by yourself. And by the time you leave that conference, you'll certainly be a lot more knowledgeable, but most importantly, a lot clear and a lot more confident about what you're doing, which is the goal, right? Now, let's see. Cyclicals will fall and rebound, right? But the next category I'm talking about is the category that compounds the most, and that is the growth category. Okay. Now, in the growth category, these are the companies that actually are the growth engine of that portfolio. Remember, the first three categories are not very growth oriented, income oriented, defensive oriented, and making sure from time to time, if the season is right, you can make some money. Now we are talking about growth. This is the engine that actually expands your portfolio because these are companies that are geared towards growing, generating more revenue, generating more profit, increasing the value of the company, thereby increasing the value for shareholders. Now you realize something. Growth companies generally don't pay a dividend. If they pay a dividend, it's very small, maybe 1%, 0.5%. The reason why they don't pay a dividend because they chose to use the profits they make to reinvest in the business. And when they reinvest that in the business, the value of the business grows. By extension, the stock price grows. And by extension, you, the investor, you have a better stock price and growth in your portfolio. Remember, I talked about the three different things companies do with the profits they make. For growth companies, they don't reinvest, they reinvest it. They don't redistribute it as a dividend. So you're talking about companies here like Microsoft, right? Apple, Nvidia, all these top technology companies you hear a lot about, right? All these technology companies are actually growth companies because their number one goal is to be able to grow the business, develop the business, increase their profits, and keep the value going. Now, for growth ETFs, you have ETFs like QQQ. QQQ is actually an Invesco QQQ Trust, which is an ETF that covers 100 of the top companies on the NASDAQ. Now you have to understand the NASDAQ is different from the New York Stock Exchange, but all of them are considered part of the stock exchange, right? You have things like the NASDAQ, you have the other one that handles, things like corn, oil, and things like that, gold, silver. So you have to understand the NASDAQ is focused only on technology and growth companies. So QQQ is an ETF that has 100 of NASDAQ-based companies within that ETF. And so if you're buying QQQ, you are basically betting in favor of the growth of growth companies, mostly technology and high growth companies, right? You also have an in the ETF like VUG. VUG is a Vanguard growth ETF and it's a broad US growth exposure. So basically, it's a company that doesn't only include technology companies, which are fast growing companies, it also includes other growth companies from other industries. You also have the ARKK, which is ARK Innovation ETF, which is disruptive technologies, right? ARK is focused on investing in technologies that are not very well, they are known right now. They maybe are not as proven as it's going to be in 20 years. So what ARK is trying to do is trying to invest in the Nvidia 25 years ago. It's trying to invest in the Apples 25 years ago. So it's trying to invest in those companies which are the technologies of the future so that people have a little bit more appetite for risk. You invest in things like ARC, which is an ETF that covers those innovative and companies of the future. You know that in the short term, there might be mighty volatility, but in the long term, those companies might pan out to be great companies, right? So we are talking here about the fourth bucket, which is a long-term growth. And you have the options of those companies, and of course, you have the ETFs. Now you see how the resilient portfolio is coming together, I hope, because you realize that we talked about the basis, which is the security. We talked about the income piece. We talked about cyclicals. Now we are talking about growth. So now growth, because it grows so fast, it also comes with volatility. You must always remember that investing on the stock market, the faster and the bigger the growth, the higher the volatility, and of course, the higher the risk. It doesn't mean there is no risk-free business. There is no risk-free investment. It's just about your risk appetite. It's just about how much risk you want to take and also how much you want to balance your portfolio so that when these growth companies are growing, your portfolio is doing good. But if the companies start dropping some, your portfolio, your entire portfolio is not suffering. That's why within the framework of the portfolio, in my case, I generally recommend to my coaching clients about 20% of your portfolio within the growth area. So 20% of the companies or the ETFs you invest in have to be growth ETFs because that is your engine. Now, if you even have more time, that applies to people who are right about the 40, 50 years old, right? But if you have more time, like a younger person starting to invest at their 20, that should even be a bigger part of their portfolio. You know why? Because they have a longer way to go. So they have enough time to master the volatility. They can handle the changes in economic situations. They can handle the changes in presidents. They can handle the changes in government, and they still can be able to have value at the end of the day. So I hope this is starting to get you to understand a little bit. If you've been attending my live streams every evening, I am telling you this is a university in investing. Trust me, I know what I'm talking about. No brag, no bullshit here. I'm just telling you that if you attend my live shows consistently over the next many weeks, you will be way, way ahead of many of your peers when it comes to just understanding a little bit how the stock market works. And the reason why everyone has to understand it is because it is as important as civil rights. Guys, it is that important because that is the number one wealth building machine in the world. If you are not even living in America, you have access to the US stock market, do well to invest. Recently, there's a platform through which you could invest, something brokers. I forget their name. Something brokers, right? This platform is now available in countries like Cameroon, Nigeria, Ghana, Senegal, Congo. So people can sit out there and participate in this stock market. That is a way of building wealth, guys. So you don't need to be an expert, but this just helps you to have a little bit of understanding. So that way, when people give hype stories around you, people come and tell you about things to invest, you don't just run to go spend your money to invest in things you don't understand, you don't believe in, you don't know, and you're not convinced about. You can be able to take a break. You can be able to say, oh, thank you for that recommendation, but I'll go home and I'll do my own research and try to understand exactly what that company is about. Because until you can get to that place where you have a basic idea of how it works, it will be very, very risky for you because you might end up losing a lot of money, right? So now we understand that growth builds wealth, but opportunity can multiply it, right? We are talking here about the growth bucket. Now let's move to the fifth bucket. The fifth bucket now at this level, we are getting higher and higher in the ascendancy here. We've already built the solid foundation. We've built the walls. We've built the floor, the roof. Now we're going to the second floor, right? Which is opportunistic and special situations. Now, opportunistic investments, these are actually tactical investments. These are investments that lie between the first three I talked about, the defensive investments, income investments, the cyclicals, and the growth. They are not as fast as the growth. They are not as slow as the cyclicals, but they are somewhere in the middle. These are investments like in finance industry, in the finance companies, like banks, for example. You're talking about investing in companies like JP Morgan Chase. You're talking about Bank of America. You're talking about Goldman Sachs. You're talking about Visa card. Visa is the number one credit card payment processing company in the world. You're talking about American Express, MasterCard, right? You're talking about some of these payment platforms like SoFi. These are companies that actually don't grow too fast, don't fall too fast, but grow reasonably, right? In this category, you have finance ETFs like XLF. So if you don't want to invest in the individual stocks, you can buy the ETFs, which is like XLF, which is a financial select sector spider fund owned by the spider company. You have KBI, which is also banking focus, and you have IYF, which is the iShares US Financial ETF. That one is very rate sensitive because it deals a lot with high level finance companies. So anytime interest rates change, it will naturally affect the performance and the movement of these companies. But of course, it has to be part of your resilient portfolio because at the end of the day, you need to be able to have a piece of the different aspects of the economical outlay. So that way you are growing in a very balanced way. And if you don't have the heart to stomach downturns, when downturns come, it's not going to be huge, right? So modern portfolios also need asymmetric exposure. When I say asymmetric exposure, it basically means in as much as you're exposing yourself to all of these different, very calculated, very disciplined, risk managed investments, there's a small percentage of your portfolio that has to focus on investing in asymmetrically risky bets. But that doesn't have to be a big part of the portfolio. At least that's what I do with my portfolio. You can do with yours differently if you think so. There are some people who are very risk averse, but in my portfolio, that's just about 5% of my portfolio. And we are talking here about what? We are talking here about companies, technologies that are not proven yet. Well, are proven, but are not proven, have not been embraced completely on the marketplace. They are still shaky, but their utilization is very clear. People have started to accept it. People are projecting that it's going to be big in the future. You can see it growing. You can see the movement of these investments over the last couple of decades, but it's not really there yet because it hasn't been there for 20, 30, 40 years yet. So you cannot feel completely confident about them, but it gives you a chance. It gives you the ability to really make some massive upsides if it works. But if it doesn't work, the downside is not too huge relative to the size of your portfolio. I don't know if you understand what I'm saying, right? We are talking here about companies like Bitcoin, for example. Let's talk first about cryptocurrencies here. We're talking about something like Bitcoin, right? We're talking about something like Ethereum. These are cryptocurrencies and decentralized financial platforms because Ethereum is a decentralized it's a decentralized platform, right? Bitcoin is a means of payment. These are companies that are actually have proven that this whole concept of cryptocurrency can work. And people actually accept it as a payment method. You can actually pay for goods using Bitcoin. There are a lot of banks, a lot of companies that have started accepting payments using Bitcoin, right? Now it's not as popular as the traditional currencies we use, notes and credit cards and things like that. But it is growing in popularity. You would have certainly noticed if you've paid any attention to the movement of Bitcoin. Bitcoin is a thing that there are people who actually had Bitcoin given to them in college tests and different things about 15, 16 years ago, and they used it to buy pizza. Today, the value of the 4, 5, 6 Bitcoins they gave them would have been in the 500 to millions of dollars, right? So you must understand that this is part of the future, but you don't want to bet completely on that, right? You also have crypto ETFs. Instead of betting on the individual cryptocurrencies, you could bet on the crypto ETFs. A lot of people don't know that cryptocurrencies also have ETFs. You have an ETF like BITO, which is BITO, which is owned by ProShares Bitcoin Strategy ETF, right? This is futures-based Bitcoin exposure. So this is an ETF that invests in cryptocurrencies, mostly Bitcoin and other related cryptocurrencies. And they're projecting that as the cryptocurrency market grows, cryptocurrency becomes more popular and becomes more commonplace in the market, these ETFs are going to grow too. You have another one called IBIT, IBIT, and that's the iShares Bitcoin Trust ETF. That's a spot Bitcoin, right? It's owned by BlackRock. That is one of the different ETFs. There are other ETFs that invest basically in cryptocurrencies, in Ethereum and in different cryptocurrencies. You can check them out, right? So if you are worried about investing directly in Bitcoin or Ethereum, you can actually go ahead and invest in these ETFs because that mitigates your risk, right? So it's important also to understand that part of that can also be private equity. And I want you to pay attention to this, right? Because private equity is one of those things that for in many years was the domain of the rich. Only the rich could access private equity. Even apart from that, you needed to be a certified investor. You needed to be an accredited investor, which means you have to prove that you have a certain amount of money and a certain criteria to be able to invest in private equity. But today it has been democratized a lot more. There are even companies that you can go there. There are websites and platforms that you can go there and invest in companies that are not listed yet on the stock market. Because private equity, just like the name says, it is private companies, right? These are not publicly traded companies. And there is a difference because when you are traded publicly on the stock market, there is certain requirements that is expected of you as a company. Compliance, reporting, and different things. That is why the information about private or about public companies is public. You go to websites like investor.com, you choose Apple, for example, you see everything about their finances, you see everything about the company sales, you see all those information. You also hear about quarterly reports, right? Quarterly earnings report. That is when companies come to report to shareholders how they've performed in the last quarter. And it's important to understand that is a regulation by the government because you are a public company. You seek people's investments publicly. You ask people to invest in your company publicly. So the government regulates you. Private companies too are regulated, but there are certain regulations that don't apply to them because they are not traded on the public market. So it makes it difficult for most people, everyday people, to have access to these private companies. But right now, that has changed. So for people who are also willing to take a certain kind of risk, you can also place some bets on private companies. This is what creates the element of speculative, right, and private investments within private companies, right? So you have companies like, for example, right now, you have companies like which one can I use as an example as a private company? It just ran to my mind. The mother company of ChatGPT, for example, it's still a private company. It hasn't been public. They are planning about an IPO, which is an initial public offering coming up soon. You have companies like IAX, which is what's the guy's name? The owner of Tesla, right? He has another company that has X and his space business and all of that packaged in that company. He's contemplating about bringing that to public offering. But there are people who invest in these companies, right? There are different private investments that you can invest in. There are investments I do which involves, investing in storage units, right? These are private equity businesses and startup companies. The truth of the matter is private equity is very risky. The risk is significantly higher because these companies are not proven, and most private equity companies fail. Just let me be transparent here, right? That's why if you want to include that as part of your portfolio, you got to also understand what you're playing with. The percentage of your portfolio you assign to private equity, you got to be able to understand the risk that is inherently involved in that process. So that way, if it doesn't work, you don't complain. Personally, as part of my financial plan for my family, I've invested in multiple private equity businesses over the last 10 years, at least 10 of them, from storage units to pharmaceutical companies that are coming up to cancer research companies and things like that. And truth be told, each time I'm investing in these companies, it's not a big chunk of money you put in. I also recognize that that money can be lost. And I'm okay with that. I'm okay with that. That it can be lost. It is fine. Because you must understand something when you're investing, right? That felt good. I mean, for those who think it's easy, talking is not easy. When you're talking for 30, 40, 50 minutes, it's not easy. It's no joke. So, but by the way, you must understand something when you're investing, right? The first question I ask everybody who comes to me for consulting or any kind of coaching: how long do you plan to invest? What's the goal of your investment? Why are you investing this money? How long do you plan to hold it? Now, if it is money you need in less than 1 year, 1.5 years to 2 years, I would suggest very strongly that you put that money in a high yield savings account, or you buy some CDs with that money so that the money is available and it's not exposed to a lot of volatility, right? But now, if you're planning to invest for 2 to 10 years, that's the kind of money now you want to invest directly on the stock market, because it has time to go through volatility and still give you results. Because investing in right companies, right ETFs over time, it will always grow because the market trends upwards, right? So you have to understand these things. If it is money which is like emergency fund, I generally recommend people must have 1 month emergency fund. If you're just starting, you don't have, but you must keep building. The ideal situation is to have 6 to 12 months of emergency fund, but generally 6 months is okay. Well, you have to always think about your emergency fund, like if something happens to you. Maybe you can't work for a period of time, you lose your job, your source of income dries up. You at least have a means by which you could live for 6 months before you start building again and you start looking for the next thing to do. You must understand that I've been fired multiple times in my life. So I understand how important emergency funds are, because you always need it, especially in this time and age where we have a lot of doubt in the economy. You don't know if things are going to be what they say it's going to be. Job security all of a sudden has become job insecurity. So you can never tell, right? So you want to be able, certainly, that you want to be able that you have a you have a nice emergency fund, so that in case something happens, you can certainly fall back to that. So when it comes to investing in these alternative assets like crypto, like private equity companies, and things like that, you must understand the risk is significant, but so is the potential upside. A lot of people focus only on the potential upside, and that's why I'm teaching you today how to build a resilient portfolio, because a resilient portfolio takes away the emotions. A resilient portfolio requires that you build it with thoughtfulness. You build it with the presence of thinking and not how you feel, right? A lot of people will hear about, oh, some young person made 25 million because they held their crypto and sold it. They bought it at 1 cent, sold it at 100, at $1 or something. But you know what? When you think about it, it's 1 in 1 billion. What are the odds that you could be that person? It's very slim. So you really cannot go with those extraordinary circumstances, because it's not the norm. So when you're investing in these high risk opportunities, you always have to think about the downside too. Don't only think about the upside. Don't only think about the fact that Bitcoin might be my $1 million in 10 years. Think about the fact that it's still not regulated. At some point, government regulation will have to interfere. Nobody knows what's going to happen with that, right? At some point, there will have to be a way. I understand the platform self-regulate. If you understand the technology, you know all of that good stuff. But at the end of the day, governments have a right to protect their citizens. So government will use that as an argument to find a way to regulate the industry one way or the other. So nobody knows where that is going to. So you cannot really bet on that completely, and you cannot bet on that heavily. Or if you're betting on that heavily, you are doing that consciously. You are doing that understanding that it could be one way or the other, right? So now I want us to zoom out a little bit, right? And see how all of this fits, because it's very important to really see how all of this comes together. So now think about your portfolio allocation like this. Your portfolio allocation is going to have a defensive piece, right? Let's say that defensive piece could be 25%, and and the defensive piece, of course, includes companies like the McDonald's and all of that. Now we also have the dividends and real estate piece, which includes companies that pay a lot of dividends, like Johnson and Johnson, PepsiCo, and these kind of companies. That could be maybe 20% of your portfolio. You have the cyclical piece. The cyclical piece is like the caterpillars I talked about, right? These companies that actually go back and forth depending on the cycle of the government, what the government is trying to do, and things like that. You also have the growth piece, which is now the technology companies, which most of us hear about all the time: Tesla, Apple, Amazon, all these companies. That could be about 20% of your portfolio, because that is the growth engine. That is what you want, bringing in profits and growth into your portfolio. Now, you also have the opportunistic piece. The opportunistic piece, now we are talking about, like the financial companies, JP Morgans and things like that. Then you have the crypto and alternatives, which is what I just talked about lastly. That's about 5%, right? And that brings your total for your portfolio to 100%. Now, what that does is that this kind of structure removes emotion. This kind of structure removes the extreme fear that a lot of people feel when the market is starting to turn red. It takes away that urge for you to want to sell your stocks when the market is red, because you know that you took some time and there's a reason why you organized your portfolio that like that. You know that no matter what is happening, your portfolio is not going to dip too deep. And even when you see the portfolio red, you see the portfolio looking like a pullback, you don't feel that urge in your stomach to throw up. Because trust me, in this game, you need to have a strong stomach, especially when you're starting off in investing. Sometimes you look at your portfolio, you will feel like throwing up. Those are the times when, because of your disciplined approach, because of the fact that you build your portfolio with a strategy, even when you feel that way, you are confident, because you know it's a matter of time, it's going to turn around again and start going up. The market usually does one or two things. If it's not coming down, it's going up. Sometimes it could go sideways, which means it's not coming down, it's not going up for a brief period, but it generally is doing one of the two. And you always have to remember, the market goes up 78% of the time and only goes down 22% of the time. So anytime there's a downturn in the market, anytime there's a pullback, anytime there is a brief sale off on the market, don't panic. Understand that that is just one of the 22% of the time that it goes down. The rest of the time, which is 78%, it goes up. So that really means if you invest in a company that is proven, you invest in ETFs that are proven, you have a 78% chance that it will grow over a 22% chance that it will lose money. I want you to understand that, guys. I want you to understand that. I spend a lot of time talking about the details because I want you to understand the fundamentals of investing. Because once you grasp that fundamental, you understand the basics, you will never panic. You will never fall into the common traps that a lot of people fall into and lose money. Trust me, on the stock market, somebody only buys because somebody is selling. I want you to understand this. That's how the stock market works. If 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 nobody is selling, nobody will be buying. Because companies have a certain amount of stocks. It's not infinite. There's a finite amount. So somebody has to be selling for somebody to be buying. So when the market is red, the people who are exposed, the people who are intelligent, the people who are educated, the people who are experienced, people like you will be listening to me, you will be the ones on the buying side. So the people who are panicking are selling at a loss, and you are there buying and accumulating, because you know that this is the 22% of the time when the market dropped. Once you buy and hold, 78% of the times it's going to rebound again. Yesterday, if you didn't watch my live show yesterday, go check it out. I talked about a concept called tennis balls and egg stocks. There are some stocks on the stock market that are egg stocks, and there are some that are tennis ball stocks. In fact, most of the stocks on the stock market are egg stocks. What does that mean? When the companies fall during tough economic times, they never rise again. They break like an egg. A very small percentage of companies on the stock market are tennis ball companies. These are companies that when they rise, even in a downturn, when they drop, they still have the ability to bounce and go back up. And those are the kind of companies you want to invest in if you are investing in individual companies. You want to invest in tennis ball companies, right? So basically, if you really want help building this kind of portfolio with your income, your goals, your life, that's exactly why I did the clarity, legacy, and wealth blueprint webinar, which is coming up on February 26th. It's exactly for people like you watching me right now. Because I want to create a possibility for you not to necessarily be a follower, but to be somebody too who can make independent decisions based on what they know. Right? In the 90 minutes of that particular webinar, I will help you organize your money, build a clear plan for you, show you step by step how you can start investing. And if clarity does it matters a lot to you over worrying about money, you should be part of the VIP part of that. Because in addition to the 1 hour 30 minutes of the general webinar seminar, I'm going to have 1 extra hour with VIP guests. And in this 1 extra hour, we are going to have a guaranteed question and hour session and answer session. So if you have burning questions you want to ask me, you have to be part of the VIP package, right? And it's only $197. You're not breaking the bank here. It's a trust me, the value you're going to get out of that webinar, you will be the one to call me to say, Mr. Achu, we cheated you. You should have done it more expensive. And I'm going to do it more expensive for sure. Right? And I will be. The way you see it now is not going to be the same the next time I'm going to do it. And the next time. So take advantage of it right now, right? So if clarity and speed is important to you, you have to be in that webinar. I'll leave the link to that webinar down in the description. Check it at some point after the live and make sure you secure a seat. My goal is to have very limited number of people because I want to make sure I can answer everybody's question in the VIP session, and I want to make sure everybody who is there has significant value. I don't want it to be an overcrowded webinar where it's just hard to manage people and people are not able to really get the value why they came for it. I want everybody to leave that webinar with at least a roadmap to be able to start investing. And now, after the webinar, if you still want me to work with you one on one, there will be an opportunity to do that. And I'll be sharing all of that information in the webinar. In the meantime, if you look in the description of my videos on YouTube and Facebook, you could always see a link. You could book a call, a one on one call with me before then. For a small fee, we can have conversations about your plans, what you plan to do, if you need some assistance with different areas of investing. But trust me here, guys, the one thing you need to understand is that the greatest losses you face is not what you lose investing, but it's what you lose in time you didn't invest. I want you to understand what I'm saying. Because when you understand what I just taught today about building a resilient portfolio, you realize that discipline beats prediction, that the stock market is not gambling, that the stock market is not predicting, that the stock market is not trying to foresee, it's not trying to look a crystal ball and make judgments, that the stock market has an organized framework by which if you implement diligently over time, you become very successful. So you don't need to predict no recessions, you don't need to predict no bull markets, you just need a system. You need clarity. You need a clear understanding how it works, right? Because time plus discipline equal to wealth. And this is exactly where most people get stuck at the level of implementation. So once you gather this knowledge I'm giving you, make sure you take one thing out of it and commit to implement that, right? Commit to implement that. Don't just take it and go sit on it. Because when we're growing up, they always told us knowledge is power. That is a big lie. Knowledge is not power. You know what is power? It's knowledge that is applied. If you don't apply the knowledge, it doesn't work. It doesn't serve you. It doesn't serve the person next to you. It doesn't help nobody. That is why it's important to understand that application every day, application every day will beat knowledge without application. You see, in this present economy we are in this present dispensation where the world is going to in the next few decades, the people who are going to win are the people who are implementing the fastest because they are the people who are failing the fastest, learning the fastest, and getting best the fastest. Don't delay. Don't hang on to the information and keep procrastinating. Hang out with people who are going in the direction you're going. Check my YouTube channel. There's a link there. You can join my private community, right? Hang out around people who are going in the direction you are going. Think about it for a second. If I want to learn how to cook the best Chinese food, who am I going to talk to? Am I going to talk to a Chinese born cook, or am I going to talk to a Cameroonian born cook? Of course, I'm going to talk to a Chinese born chef, right? That's how it is. If you want to win investing, if you want to build wealth investing, if you want to make money investing, you have to be hanging around the information, around people who are going in that direction, because it's a continuous journey. Even though I talk to you today, I'm not where I aspire to be, but I'm not where I used to be. I don't know if I make sense. Everything I share with you, those are things I'm doing for my own self. Those are things I'm also doing to help move myself, move my family forward, move my loved ones forward. Right? But it's left to you to implement. You can get as much knowledge as you want to. Knowledge serves no purpose if you cannot implement it. So I hope you found something valuable in this presentation. Please go ahead and share this. Invite your friends. Next time I do a live stream every day, 8 p.m. Central Time. Sorry, 7:30 p.m. Central Time, 8:30 p.m. Eastern Time, right? And if you have specific topics you like me to talk about, drop that in the comment section. Let me know. I want to give a big shout out to my friend, brother, Dr. Harry Gedimo. Thank you. I see your comment. Keep preaching, brother. We continue to preach the gospel, man. This is the gospel of life. This is no joke. Nobody preached this gospel to us when we came to America, but we're going to make sure nobody who comes after us doesn't hear this gospel. As long as we breathe, as long as we're alive, we'll preach this gospel till we are planted, man. Hey, thank you for hopping on. I'm just looking now on the Facebook page if there's any questions, any comments. Okay, wonderful. So, guys, you have a wonderful rest of your evening. Until the next time, be well, be blessed, and by all means, never stop being a blessing to somebody. It doesn't matter what anybody spoke upon your life. It doesn't matter the circumstances with which you were raised or you were born. What you need to understand is that all those stories that talked about you not being capable, you not being smart enough, you not deserving of success and achievement in your life is a lie. Because what matters is not what happens around you. It's not even what happens within the environment where you grow up. It's what happens in you. Because until the inside perceives it, the outside will never achieve it. Until the mind can conceive and believe it, the body can never achieve it. I want you to believe in your dreams. I want you to believe in your capability. I want you to believe that, yes, truly, you are enough. Go out there and win. And I'll see you tomorrow during the next live stream. Until the next time, be well, be blessed, and by all means, never stop being a blessing to somebody. Bye for now.